Good day, traders. This is Richard. Today is November the 6th, 2023 at 5 a.m. Pacific. We just changed to daylight savings time. So what we have here is a montage of 8. Actually, there's probably 12 instruments that we watch. The first one is up in the upper left-hand corner, and it's our favorite crude oil. Next door is the euro currency, 6E. So the symbol for euro currency is 6E. All of the currencies in the futures they start with a 6, and there's about 8 of them that we watch. There's probably 10 or 12 total, but we don't watch the Mexican peso or the Russian ruble or the South African. What we watch is the euro and the pound and the yen and the Australian dollar and the Swiss francs and sometimes the Canadian. Primarily, we watch the euro, and we watch it trade against the dollar. We watch the dollar, it's down here below the euro. Its symbol is DX. And to the right of the dollar is the two more energies underneath the crude oil up here on the top left. And those two are gasoline, which is in front, and behind gasoline, we have natural gas. So I just clicked that little arrow, that little white arrow there after natural gas came up, because I figured that if that arrow is there, that we're not seeing all the candles. So that's something you always want to do on each one of your charts. So if I go up here and click on crude oil, and come up here and pull that down a little bit and hit that F, that's one way to clear it up. That makes you reasonably confident you're watching all of the candles. You can see them all. You're always looking at the hard right edge for the last candle. And we should have at least one instrument on this page with a bar timer. I'm going to add it now. It's called just that, bar timer. I go into indicators, and that'll bring up a dialog box. And then bar timer is right here in alphabetical order. I'll just highlight it there and add it. And then it gets added down here. And then I apply it over here. And then I and the candle we're looking at right here, I'm going to spread these out a little bit more so they're a little bigger and you can see them better. The candle we're looking at is right here, and it's got 11 minutes and 43 minutes to go. So it started about 3 or 4 minutes ago. Because we watch 15-minute candles intraday to find trade setups. And we had a beautiful sell signal here on oil about 2 hours ago. A little over 2 hours, right here at approximately or exactly 2:30 a.m. Pacific. Now that it's 5 a.m., we've already come all the way down here. We could have gotten short up there at 2:30 and ridden it all the way down here. But we're getting to a point where it's probably going to turn and go back up again, maybe, but maybe not, because oil is in a downtrend. You can tell from looking at this 3 or 4 days here. I got now 3 days. I'm looking at oil, Thursday, Friday, and Monday. And you can see that oil is in a downtrend, but we got to go back another week or two to see that. So we're going to go back in time to approximately October the 15th. Or is that the 18th? Yeah, that's the 18th down there. Okay, so you can see that we've come down from this high up here at 83.50 all the way down to 81 right now. And earlier this morning, we were up here at 82. And that's probably going to be the high of the day. And we're coming down because we have come down from a higher high back here a couple of weeks ago. Now, almost, well, 3 weeks ago now. So here it is when it was up here at 89, almost 90. And we've been coming down, down, down. You'll notice how it always comes down a little bit and it moves back up. And it comes down, it moves back up. It comes down, it moves back up. It comes down, it moves back up. We call this behavior pattern recognition. We have to recognize the pattern that repeats itself over and over again. And if we're in an uptrend, that pattern keeps showing us up and up and up, but we're not. We're in a downward pattern, so it's showing us down, 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 down. So I'm going to push this over to the side here, squinch it together so you can see how the pattern unfolded over the past, now, way back to September 24th. So we got 2 months here, September and October, and a little bit of November, the latter part of September, all of October, and a little November, and we've been coming down. Now see this big triangle that I drew over here to indicate that the price was coming down. It's out of kilter because it was drawn several weeks ago, and the charts move around, so it was drawn from right there, I think, right there on that high. And so here's the bottom of that candle down here. I'll just replace it. It got moved because every time a new candle comes along, it kind of changes the old candles a little bit. Not much, but enough that they mess up your chart. So this was pointing down all the way down to 73.77. Now we're not down there yet, but we're probably going to go down there. And if you really want to know what's happening in the future, you look at a longer term chart. Like instead of looking at 15 minutes, you look at a 4-hour, or you look at a daily, or maybe even a weekly. And you can see the trend in that too, and it'll show you that we're in a bearish downtrend. Now, how far are we going down? Well, this says we're going down to 73. We haven't got there yet, but we're working on it. Takes a long time to move 10 points from 83 to 73. It doesn't happen. It happens in a day occasionally, but it usually takes a little longer than that. And we don't really care what the news says or what is going on in the world. We don't care what wars are going on. We don't care what news is being said. We don't care what the talking heads say. The talking heads are there for one purpose, to get a message out that somebody is paying them to say. It might be a government agency, maybe the EIA. The Energy Information Administration has been told by the Department of Energy to give us a report every Wednesday at about 7:30 Pacific. And that's the oil report. And they tell us how much oil was put into the national reserves or taken out of the national reserves. But nevertheless, somebody was paid to tell us something. Now, then you got the big news companies, British News Agency, we got CNBC, we got Fox Business, we got Fox Regular, we got CNN, and we got MSNBC, and we got so many people telling us so many different things. We don't know what to think or believe. So we don't believe any of it. We don't care about it. We don't listen to it. We read these charts, and these charts tell us what's going to happen. And I was talking about how these things, these patterns move. We call these movements A, B, C, D, because A, B will equal CD. I'm going to show you why and how right now. You see this A up here, and this B down here, and that's C right there. And way down here is D. Now I have a tool that I pay some extra money for to give me this drawing capability, and it's called the Ultimate Drawbar. I've owned it since sometime around 2016. I can't live without it because it helps me draw the patterns on the charts. So I'm going to show you now how to draw the pattern without that drawbar. So we take this and we draw from A to B and click. Then we drag it up here to C and we click. You see it's right on top of what was already there. And that line just came all the way down there. And that is D. That is C to D is the same as A to B. Now I'm going to show you that with a little arrow tool that looks kind of like that. I'm going to take it off now. And I'm going to grab it. And I'm going to draw from right here, right down to here. And then I'm going to take that tool, or that arrow. I want to take that little red arrow there it is. And I want to put it on top of this yellow thing. See how it's exactly the same length from there down to there as this A to B. So this is the most important thing you need to remember. AB equals CD. Always. That's what the market is doing. It's moving from A to B, and then it goes from B to C, which is a much shorter movement. It's about 38% to go from here up to there. And it's 78% to go from here down to there, roughly. Okay. Now these Fibonacci levels that are in here, they're right over here. You can see them. There's 161 extension. Here's 127 extension right there. There's the top at 100. Here's the bottom at 0. And then this is negative 27 and negative 61.8 down here below. So the range of movement goes from an extreme expansion of 161% all the way down to a negative 61%. And that's what we've got right here. That's covered the area of the candle. So this thing that's drawn on here maybe 3 weeks ago is still valid right now. And it's moving around inside. And we drew it from the high over here to the low when this was the low and that was the high. Now we haven't gone above that high yet. We haven't gone above this low yet. We're working on it. We tried to go down lower last week, and we didn't make it any lower than it had been over here 3 or 4 weeks earlier. So there's some support there that's keeping it from going any lower. There's some resistance up in here that's keeping it from going any higher. So we're trading in this little tight range here of about how many points? Well, here's 80s. There's an 88. And down here's 80, about $8,000. When it goes from 80 to 70, that's $1,000. We're talking about going from 88 to 74. And that's, you know, about $7,000 or $8,000. So we can take a little bit of money out of the market by selling at the high and buying down here at the low. You don't know exactly how far it's going up, but if you look at the history, you can tell that it's that these waves, which we call harmonic numbers, it's about 880 ticks. There's 1,000 ticks in an oil point, and about 880 or $880 is the typical movement in a day. And it's not precise. It's just kind of about 880. So if you went through here and drew boxes around the large swings, like I could do right here, I'll just draw a box from that low up to that high. That might be about 880. I need to stop drawing. Okay, so that little blue box be about 880 from there up to there. Typical. Now there's a little bit bigger ones and a little bit smaller ones, and they're not all the same size, and they're not all 880. Don't get the point. I'm just trying to give you an idea of what you can expect in a day of trading. You don't want to expect 2,000 ticks. It happens once in a while, but don't expect it. Expect somewhere between 500 ticks and 1,000 ticks. Expect that. Going to be in there somewhere. You don't know exactly what, never will know how smart you are, because it moves around. And because there's a lot of people pushing on it. There's people pushing the price down. There's other people pushing the price up. They're always pushing on it. It's kind of like crowd control. If you're in the sidewalk of New York City and during rush hour, you're trying to go in one direction, but there's a whole bunch of people on the same sidewalk that want to go the opposite direction, and you have to move a little bit, get out of their way, or you bump them. And you don't want to bump people. Might get hurt, might hurt somebody else. So you try to avoid bumping people. On the trading, those are transactions, those bumps. That's when you buy something or you sell something. Bump, bump, bump. And if you want to know how many transactions happen over the course of a minute or two, well, you pull up a tool called the time and sales. I have to go into new. So I have to move this thing a little bit out of the way so I can see new. And here's where I find time and sales. It's time and transactions. And so the transactions are timed. Now, I want it to do oil. So I'm going to color code this green here. And then I'm going to color code this. Well, no, I'm going to use red because that's what it's already color coded. So you can see all these buys going through now. There's a sell right there, but there's a bunch of buys going through. It's probably going up a little bit. There's more buys here than sells. And that yellow one there is right. It's a buy right in between the sell and the buy price, the bid and the ask price. So this is in the middle. It's less. You see how fast that's moving? That's moving so fast I can't even see it. So the way I control this thing to where I can read it is I change the property here and only show 3-lot transactions or greater. So if I just come down here and change that 0 to a 3, it's only going to show me the 3 lots or anything bigger than 3 contracts in a transaction. And now you'll see it's going to start moving, and you won't see any more 1s come through. And that's a 3 lot. You know, a lot of people trade a 3 lot. Typically, that's my favorite size to trade. I think a 6 lot or 9 lot or 12 lot's way too much for my pocketbook. So we trade what we can. I'm very conscious of risk. How much is it going to cost me? How much am I going to have to put down in order to make the money I'd like to make? And the optimum is probably a 3 lot for me. Somebody else, I trade with between a $5,000 and a $10,000 account. Sometimes I trade with a 15 or 20 because I made some money for my $10,000 initial size. And so I've been making money and I haven't taken it off the table yet. So maybe I've got 15,000 in my account, and that's because I've made some money since I set it up or last added money to it or deducted money from it. Because when I've made 17 or 1,000 or so, I take some of it off and put it out of harm's way and go buy a CD with it. I don't need it to trade with. I can do all the trading I can stand with $10,000. I watch my risk. That's my risk. That's what I watch. I protect my 6. So protecting your risk is everything in trading. If you get that little message into your head, and it's not how much money you make, it's how much money you don't lose. Now, that's not an original statement. I've heard that made by a dozen people that are smarter than I am, that have been around a long time. One of my favorite guys, his name is Larry. We're going to listen to him in a minute. He says something similar to that. So now you have an idea of what we're doing. And now it's not about making a lot of money. It's about avoiding risk, about not losing money. So when you put a trade on, you want to be reasonably confident. You want to be reasonably confident that you are competently placing a trade that may produce the desirable result. So what I'm doing now is I'm pushing this around to where we can see the highs and lows easier and see what the trend is. So you can see the trend is down. I could draw a trend line here for you to show you that, and I'm going to. So we're just going to draw from, there's higher highs over there. You can see them, but we're just going to draw from this one right here. And we have to skip that one in the middle because this one's here. So that made a new high. And you might think, well, the day that it made that new high, you were probably thinking, hey, this trend could be turning. It may be going up. Well, it went above that, but it didn't go that much above that. And now we got all the way down here, and that's a lower low to this. So that's a downtrend down there too. So let's draw a trend line on those angles. That's another angle to the downside. So it's going down there and it's going down there. And there's a lot of breadth there, a lot of breadth. But overall, we're heading down to the 70s. But we've been heading down to the 70s for about a year and a half. And it just never does get there and stay there because there's so much demand for oil. All right. Now, this was a really, really good buy signal. And this is becoming a very good this is a very good sell signal up here. I told you that was 3 hours ago. And you can see 15-minute chart. You count those candles, and there's 4 every hour. So you see there's about a dozen. This is I have 2 favorite trades, MRT and LRT. My right-hand trade, this is my right-hand trade. This is my left-hand trade. It's a buy signal. That bottom, that tail bottoming out down there, saying to me, this thing wants to go up. And if you draw a fib from the low to the high, it's probably going to want to pull back to the 38.2. It did it. This is the 38.2. So I know that this is probably a wonderful buy moment. So I can come over here and turn on my, let me get this thing out of the way here, turn on my chart trader and come over here and buy that.
Order submitted. Order filled.
And now I'm in it. And I want to protect my 6 here. I want to put a stop down here just a little bit below that low. And you can see the low, if you use your middle mouse button, is down here at 81.18. And right now I've got to stop at 81.50. I want to move that up to 17. Now that's 1 tick below the low. Let's double click that, double check that. That low is 81.18. My stop is 81.17, 1 tick below. If it goes any lower than that current low, it's going downtown. I don't want to be long if it's going downtown. I want to be short if it's going downtown. But I'm long because I'm thinking it's going up. And it's already given me a little bit of money. So you may think that I just talked long enough that I could get a trade. Well, maybe I did. But I saw that trade. I saw this thing here a minute ago. And I thought, well, that wick's not long enough to buy yet. I just know that. This wick was just about right to buy. That wick was right to buy, and it went up a little bit, but it was a fart in a windstorm. It didn't make you more than about $80, maybe $112, $120, but not the $300 or $400 we want, because we want it to go up to here, and that's $300 or $400. We're not expecting it to go up and make a higher high. We're just expecting it to go up about 38%. If it goes more than 38%, it'll head up to 61%. And if it goes through that, it'll go up to 78.6%. Those ratios are like little magnets sitting there waiting to suck it up. Remember those numbers, 78.6, 61. Here it is, it's written down here. 61.8, right there, 61.8. And 38.2, and 78.6. That's 21.4, which is the contra to 78.6. So 78.6 and 21.4 add to 100. 38.2 and 61.8 add to 100. 100 and 0 add to 100. 21.4 and 78.6 add to 100. Memorize that. Live those numbers. Those numbers become your 5 fingers. You use those fingers for all kinds of things. Just imagine all the things you use those fingers for in your daily life. Well, you're going to use these numbers for as many things as you use your fingers. You got 10 fingers. You got 10 numbers. Think about the numbers as your fingers. because they're just as agile and they move just like your fingers do, and you can twist them all around and bunch them up and do all kinds of things with them and make things happen. So memorize the numbers and then learn the numbers. Memorize them first just to give you a methodology for learning them, and then learn how they behave. Just like you have a little baby, and when the little baby's born, doesn't do much, but give it 4 months and it's doing all kinds of things. Give it 8 months and wow, you just imagine what it did the day, 2 or 3 days after it was born versus what it's doing now. Been around for 8 months, and think about it at 16 months or 2 years. They change. These charts change too. All right, so now we got $100. So if I'd gone in with a 3 lot, I'd have $300. So we're expecting it to get up to about the 78.6, the reverse. So we're looking for it to get up to at least this 21.4, which is the contra to the 7.86. And then here's 0 up here. It probably will not go above 0 because we're biased to the downside. If it goes up here today and makes a new high, it'll be a counter trend trade. And we did take a counter trend trade, but only because we wanted to take a little bit of money, meaning somewhere around $300, $350. We're not thinking about getting $500 or $700 out of a contract on this trade. We're only thinking about $300 or $400 maximum. 3 is the optimum. 4 is really a lot, and 500 would be a windfall that we do not expect. Because then after it gets up here, we're going to expect the pressure of the selling to push it down lower. And that'll happen in an hour or two. So we'll have a sell up here somewhere between 45 minutes and an hour and a half. We'll look for another sell. There's about 5 trades a day in a 2 or 3 hour period in each instrument we watch. Now, I've spent a lot of time on one instrument. I did that because we have a new person in the room, and this is foundational exploration. So now we're going to look at some other instruments. I don't need that thing there. I don't use it very much. I want everybody to know about it. So now notice all those 3s. There's a few 4s, and there's 110 there. There's a 20 up there. And you wouldn't even know those 20s were in there if you hadn't asked it to move from 1 to 3. And it's still got lots of transactions because there's a lot of 3 lights that go through. A lot of people do multiple 3 lots instead of doing a 6 or a 9 lot. They stage their entries. I want to get rid of it now. We've seen all we need of it. All right, now let's talk about the metals. All right, now look. I'm looking at gold. Why did I bring it up? Well, because gold went crazy shortly after the war. So here's November the 4th or 5th. I guess it's the 3rd maybe. And we go back here to October the 7th. Here's October the 12th. So here's October the 7th right here. It started up a little slow, and then all of a sudden it just ripped up after about 4 days of the war. So I went out and bought a little hard currency. bought some coins, and I got ripped off. But I wasn't trading those coins. I was buying and holding. I just wanted a little bit of gold in case. And I expected it to keep going up, and it has. But not as much as you might desire, but it did get up to 2,000, and it could get to 2,100 over the next couple of months, but it's much easier to trade it here. Just buy it when it gets to a bottom and sell it when it gets to a top. Now, how do you know it's a top or a bottom? Well, I showed you that. It's those little fractal highs, those topping tails, those shadows. That's what tells you when it's getting to. So what we're going to do now and look at it. Let me just call it back using that F. All right, now I want to see what's going to happen next here. So this is not a current buy or sell. This was a good sell signal. I'm going to draw a little circle around it. And we never want to take a trade unless we have a good setup, So you've all heard the expression in sports, especially track, it's ready, get set, go. You get up to your post and get down at an angle to where when you take off, when the shot is fired and you take off, you get going as fast as you can. And so you have to get ready. And then getting set is getting comfortable in your readiness and arena. And then you're waiting for the shot to go, the trigger. So it's setup, signal, trigger. Get ready, get set, go. That's in track. But in trading, it's setup, signal, trigger. You click the mouse on the trigger. So when do you click the mouse? Well, it's when you've got about that much. I'm going to draw that down to where I would be comfortable getting in the trade. I want the top of the circle at the top of the wick. And I want the wick, I want the circle to be about half of the wick. And that's where I would have wanted to sell that. It's right there. I have enough wick to say it looks to me like it's ready to go down, and I'm going to execute it. If I waited till it got down to here, it would probably go back up and take a bunch of money away from me. I don't like that. I like to get in it and have it give me money like this one did. But it opened here and it closed there. But it went all the way down to there and then came back up and closed. So you wanted to get in it there. All right. So it was a failed short. Didn't go anywhere. This, on the other hand, was a successful buy. Not a fantastically successful buy, but we want that to be right on the edge. And this is where we would have bought. And we would have made it all the way up to here. And then we would have gotten leery in here and probably taken our profit. And if you do the arithmetic, we got in here. So let's see how much we could have made. So we're going to draw a horizontal line across the top of that circle there that I drew in and up to the bottom of that circle. That's about where we'd want to gotten out of our buy. And how much is that? 1990. 5 ticks, roughly. It's $500. Gold's $100 point. So we went up. I'm just counting points now. I'm not counting the ticks. So I'm just looking at the point value. So 1990 to 1995, you have to deal with a loose change, you know, the ticks. But roughly, you could have gotten between $400 and $500 in this trade if you'd have bought it down here. And that's worth taking. And if you wanted a little bit more, it took a three lot, and you could have gotten $1,500. That's what you can expect. So always know what you can expect while you watch your six. And you got to protect yourself on both sides of the trade, the front side and the back side. And when you learn to do all that in harmony without much thinking, except you have to recognize what your setup is. Your setup is that little blue circle, and your signal is price comes to that point on the circle. Price comes to this area right here. You don't know what's happening up here. You don't want to do it up there. It could go on up further. You want to see it back off, or you want to see it move up. And so that's what I'm telling you, how much to look. That's really important information to have. It's knowing how much. So what's get ready, what's get set, what and when's go. Those are the three things you need to have a second nature. Let's go back and see what we're doing over here. Not much. Now, see how much did it work? There was a point in time when we could have made this money here, and I expect that's about $150, but not where we wanted to go. We wanted to go up to here about $250, $300. So it may still work. It's struggling to work, not dead yet. It's dead when we got stopped down here. But it's time to adjust the stop. We don't want to lose that much money. So now we're going to put it one tick below that low on that candle. Then we'll lose minuscule amount, you know, $10, maybe 20. So that's a lot better situation than this down here. All right, now the idea is to avoid over trading. And that's the thing that some of us wind up doing, and it's more detrimental to our pocketbook than advantageous to our pocketbook because we wind up losing too many times. We don't ever want to lose more than $100. I like to lose $40 or $60 when I have to lose, but 100 is the damn most per contract that I want to lose on any trade. And when I see $150 lost or $210 lost, I say, stupid, stupid, stupid. Don't do that. Not with my money, don't do that. Now, some people think that, well, it can go against you $200 or $300, but then you will get it back. That happens occasionally, yeah. Not with my money, you don't. You play by the rules. You're going to trade my money. We're not here to lose money. We're here to make money. And our traders get paid on what they end up keeping, not what they had for a few moments, but then lost. They're certainly not actual losses. They had to get cut and run. If you're going to cut and run below $100, 7 or 8 ticks. I prefer 4 or 5 ticks, but sometimes you have to give up 7 or 8, but not 15 or 25. Not every trade's going to be a winner. Now, we could have gotten short here, but I was busy talking and I didn't deal with it properly. I mentioned that it might come down below that little, that this is a doji because the price, the open and close were identical. There's no value in that candle whatsoever. But this is where we should have sold it right here, and we would be up about $200. Both the gold and the oil trade at $10 a tick, but there's 100 ticks in a point in oil. It's $1,000 point, but there's only 10 ticks in gold. It's $100 a point. So each tick is $10 in both instruments, but there's 100 ticks in oil and only 10 ticks in gold. Now in silver, which I like to trade, but it's just not as agile and active as gold. And by the way, when I went to pick up that 2 or 3 those coins last month when the war broke out, I learned something about silver that trading futures will never teach you. Silver weighs a ton. It weighs so much more than gold per dollar that you can't imagine it. You can't carry it around in your pocket. For example, I invested $6,000. I got 3 gold coins and 20 or 40, I can't remember which, gold or silver coins. And the silver coins are bigger and heavier than the gold coins. So the gold coins are much more valuable than silver in weight. You have to haul your silver around in a pickup truck or a wheelbarrow. Literally, if you want the same amount of silver as you get gold, you can haul gold around your pocket. You may weight your pocket down a little bit more than you like, but you can haul it around your pocket.
Stop filled.
You need literally a wheelbarrow or a little hand cart to haul the silver around. Silver of the same value as the gold. So I wound up getting 90% of my purchase was gold and only 10%, maybe 20% was silver. And the silver outweighed the gold 3 to 1. That's not right. Don't take that to the bank. It's just a lot more, a lot heavier. I never realized how much heavier it was. That's why gold is so much more valuable. Well, I've covered the basics of how to find a trade and how to manage a trade. Well, look at this. It went to target. I got $300. That's my aim. My target was 30 ticks and my stop was 10 ticks. I adjusted my stop to 2 ticks. And then I forgot about it until I just noticed that it went all the way up to my target. Took me out and paid me. One trade. Now we'd like to make about 5 trades a day. I've been talking for almost 2 hours. And I didn't say a lot, but I said the most important stuff you'll ever hear. Now there's a lot more to learn. a lot more before you're ready to trade with real money. I have a philosophy that I've developed over the last 25 years of trading, and I started out with stock, and then I had some people that tried to help me trade options, and of course I invested $10,000 to learn how to lose $10,000 in options, and I haven't done that since. And then I learned about trading futures, and it took me a while to really understand it well enough that I could consistently make money, because I didn't have a good trainer. My trainer was pretty smart, and he taught us 7 different ways from Sunday to trade. And if he just traded us one good way, I think I would have absorbed it and mastered the game in 2 or 3 years, but it took me 6 or 7 to really get good at it, because I got too much information from somebody I thought was pretty smart. But it turns out that he was listening to 6 or 7 different trading teachers. And so he taught us everything he learned. And that turns out that was a disservice. But when I figured out that it's not how much you know, it's what you know well that pays. Now, I want to listen to a video. I'm sure there's a new video either last night or today since yesterday.
Okay, folks, we're going to take a look at a couple of markets we should be involved in. This is the euro, as you can see here. This is going back over the last 6 months or so. And you have the nice ABCDs up. I'm not going to draw all of them, of course, but here's where we are right now. You'll see here that we've had this ABCD up into this area. We were highly suggestive of a sale up into here. That came in at 107.57. So you might even open a little bit higher here at 107.60, which is close to where we sold it. But we shouldn't get any higher than that 382, because that is a major 382 off of the high back here, folks. And as you can see, each time we've done those 382, they've been monsters. So this is just a larger time frame in here. So you certainly want to be in the euro here, risking about around 30 or 40 pips at the very most. That's $300 to $400, certainly acceptable. Okay, now just take a quick look on the S&P that we were talking about.
That's right now.
Big run up, of course, that we talked about here on the daily. It's actually clearest is on the Nasdaq, because the Nasdaq is a perfect 135 in here. We've already highlighted that to you, but you see we've gone up to the 50% level. Let's just clean these out so we can see them again clearly. That's what you like to see anyway. There's from your high down to your low, your URC. You're just at the 50% level. Went through the 382 like it didn't even exist. This was on Thursday. Here it is on Friday. Then you want to see the next one from your last high right back here. You've come right to the 61% retracement, spot on. Okay, so that means after 5 days up, we should have a pretty good correction in this area right here. The way to handle that is, if you look at this, you see we've only had a little break here. And I would suggest waiting for a small counter trend ABCD on an 8-minute chart. Watch that, because once you get this
Order submitted.
rally,
Order filled.
This is what you want to see. You want to see this counter trend rally from where it comes from. I don't care where it comes from, but that's what you want to watch for. Sell that one with your stop above the high. That would be that's what I think would be an acceptable trade, just because of all those numbers that we've hit. Let's just look at that Nasdaq, because it was quite amazing. Just get this up here, and you'll be able to see it. Here's where we are. We've already done the numbers, but there is a beautiful 135 pattern, folks. It's just as nice as can be. let's just see if it has it. We've already talked about the symmetry of all these numbers up into this right here. We had all three of them coming together, 786, 382, and the 50%. So here's where we are. If we look at this, you'll see it's on a downtrend. See, we just touched it right on the top is what you're supposed to do. The numbers are correct. Let's see how they are from high to high. Probably not as much as we'd like to see, but that would be right here. That means it would come in probably about Wednesday or Thursday if that were the case. But remember, time is the most difficult to do. So we focus on price and pattern. So time is an elusive thing that sometimes we see, sometimes we don't. But this is certainly worthy of a situation for a trade. Looking at this again on the 8-minute chart, you'll see you had a little bit of a pullback here. Again, nothing. Again, wait for that ABCD on this 8-minute chart, and you should be okay as far as being able to control your risk. Okay, now the next one that's working relatively well here is the gold market. We'll get this up here so you can see it right here. We're watching that on a 4-hour, I believe. Yes, there's where we are. Okay, there was our, move this down, there was our little ABCD right here. We suggested, that was your sale. You were right at your 78% level at this high right here, spot on there at 2011. High was 2011.30, closed 19.99. I suggested to myself that since I had a $10 lead in this, that it's worthy of keeping it overnight with a stop at break even. Maybe it gaps up here. Don't know if it gaps down here. That's better. Your first profit objective on this, if it's going to be correct, if it is a head and shoulders and has all the earmarks of it, as you can see, the left shoulder, the right shoulder, perfectly symmetrical, high to high, perfectly symmetrical. That's what it's all about. Above here, it's wrong. And if it's right, it's going to have at least this much to the downside, which is, that's a substantial amount here. At 1970, that's down another $30. That would be just about a $50 move in gold if you get that. So let's keep a close eye on that. Mainly keep it at break even is what you want to do. And then we have one other one that's in the list here. Haven't traded it very often, but it's been good to us. And that is, this is the December cattle. We're getting it up here. And as you can see, we've got the same type of a 135 situation going on in the cattle, just like we have in the Nasdaq. You can see there's your 1, there's your 3, and there's your 5. The ratios are coming in pretty good. You see we just hit the 50% ratio here. Well, we got to lower it down a little bit because we made a lower low. Let's just pull that in a little bit and draw it in again. From your high down to your low, you went right up to your 50% level, stayed there 2 days, then had the outside day to the downside, highly suggestive of the move getting ready to go down. And if you measure from the last high here, you'll see that one was at the right about the 50% level. So this is ready to roll over. So the high here was if it gets above here, if it gets above 185, it's certainly wrong. But ideally, it should start down. If we look at this on a smaller time frame, you see we didn't have much of a break here, but if we count this a little bit right here, this might be the 382 that you'd like to see. And of course, there's where it is. It only had a 30 points, so you could easily get another ABCD up in here. As long as we don't get above here, it's in a downtrend. It's my opinion. Above here, you don't want to mess with it. But this is the ideal situation, would be selling it here on Sunday night between 184 and 184.10, somewhere in that ballpark, with a stop, about 30 points. So you're risking about $200 in the cattle. So that's what we're paying attention to. So live every day in an attitude of gratitude, and may God bless. Oops, forgot something, folks. Sorry, got to get to the bonds. I don't want to do too many of these videos because I know some of you go walkos over for it. Here's let's get this up here on the daily. You can see where we are. We went substantially above the 382 that I was looking for. We went up to the 50% level. And of course, We've had a pretty big sell-off from that level right here. This had every earmarks of really being, because you had a smaller ABCD right here. You had the 78% level off of this one. Of course, it didn't work and it went up to this level right here. As we look at it right now, remember, this is a pretty big move, folks. 107, that was 7 points. That's the biggest rally we've had in this puppy since going back. You can't even see a 7-point rally back in here. Well, there's one back here. In April, we went from
and I'm looking at it right here. He's talking about the 30-year bond, and this is the 30-year bond, different symbol. He uses a different software. So his says US, like you see that US, that's the 30-year bond on his system. Mine is the same thing, only my symbol is ZB. And so this is where we should have sold it, and this is where my my report that I put up on the website is, let me see if we've got it up there. I'm going to just go over to it and check to show you where to look. So you want to go to SwissFT. I have two of them here. One of them's for alerts, and this is the page that's ours on this website, and here's the T-bond right here. And so we said we wanted to buy it, I think, but
buy it after the dip, which would be right now.
yeah. Okay, so here's this. So right here, I want to.
That one's old. That one's from September.
Oh,
You didn't have that uploaded yesterday, so I couldn't put it up there.
okay. Sorry. Anyway, I've got it right here, and it says to sell it at 113.13, and notice where that is on our chart. It's right there. And if we had sold it last night before we went to bed over here, we would have gone down to here, and then might have gotten stopped out here. If we put the stop one tick above that, we would not have gotten stopped out, but it would have put a dent in our gain, but we'd have stayed in it and been all the way down to here if we'd have shorted it there. That's what we said to do. Our weekend research effort that we do on Saturday and Sunday. On Sunday, we actually put this thing together that I showed you here that we usually put up, and it tells you right where to get in. So the Treasury would have been a good action item. You saw we made money on that crude oil because we believe we should short it. And we missed the gold. And we believe that we are bullish the S&P 500, but we also believe that it has gone up so much over the past couple of just a few weeks, really, maybe a month now. But we're up here and we're hitting our head on some resistance. You see, when we get up here, here's the primary pivot, and this is right under this is here's R1, there's resistance 1. So that's about where we expect it to get to. And then we expect it to come down to the 38.2. So if we draw the fib in here, which is already here, all we have to do is read it. Here's the fib. We drew it from here all the way up to there. And then we drew this arrow in to say we're expecting it to come down to the 382. So we can still sell it. It hasn't come down yet. It's still very strong. And we're expecting it to come down. That's why I've got that trade on. But I haven't made but $80 so far. Because that was a pretty good place to put it in, but and I don't want to get stopped, so I'm going to move my stop a little bit higher. Not much, just maybe 3 ticks. And then I expect it over the next 2 days to come down to the 382. And once it gets to the 382, I expect it to go back up, as you can see from this other arrow that I drew yesterday. We're going to get back up to there, but it probably will go further. The next time it gets up to that high, it'll go through that high and probably get all the way up to 44.40 this week. Now, you see our targets are just laying here. But on one of these sheets, we've got it in here, what we expect. We expect a pullback before it goes up. That's the message. And and we're also expecting the treasuries to go up over the year. I'm expecting the treasuries to go from this 113 area all the way up to 130. That's $10,000 a point, 113 to 130. I mean, that's $25,000. That pretty well concludes my commentary for the day. Thank you all for listening. We'll see you here tomorrow morning at 7 a.m.